So let's talk about some things that you can do to kind of reduce your payment. Some of these are going to be pretty obvious. Some of them are just ways to reduce the overall payment for the house as a whole. Some of them are a little bit more creative. So the first thing you can do to reduce your payment is put a larger down payment down or go for a longer term. I talk to a lot of people that they don't want to get a 30-year mortgage. They want to do 15 or 20-year mortgage, which gives you a higher payment. A suggestion that I often talk to them about is, hey, get the 30-year loan so you have the lower payment um, standard, the lower payment expectation, but you can always pay at a 15-year payment rate when you want to and pay the loan off in that time frame anyways. So that can be a good way to go to give yourself a little flexibility and options instead of being obligated to do the higher payment. An interest only loan, and this is not the big scary loan from the 2007, 2008 crash. Just doing interest only is a great way to reduce your payment. You still get all the lift of appreciation. You still get all the tax benefits of having a mortgage, and you can still get a fixed rate. You're just only paying the interest every month, not the principal. Some people don't like that because they're never paying the house off, but the truth is most people are selling every 5 to 7 years anyways, and you don't pay a ton of principal reduction in that time frame. You can still get some good appreciation. It doesn't let you create quite as much equity, but if you're payment sensitive, an interest only loan could be a good option for you. The other thing is to be proactive and get your credit dialed in, which is another reason why it's good to start the pre-approval process early. And by getting your credit dialed in, I don't even necessarily mean you're somebody in the 500s trying to get to 600s. You could be now the banks will put a new tranche in or a new baseline for a credit reward at like 760. So you might be a 718 and you might be able to make a couple little tweaks that we don't have the time to get into all the ways to manage your credit here. You might be able to do a couple little tweaks and get to that 760 number and save yourself in interest rate, which can be a lot of money over time. Another thing that can save you a lot of money over time, a lot of interest over time, or make the payments a little bit more manageable from a budgeting standpoint, is to pay bi-weekly, to pay it every 2 weeks. You'll actually save a ton of interest over 30 years if you do this, because you're getting an extra payment in basically every year or even two, paying every 2 weeks instead of every month. So it's a great trick there. And you can take some of the lumpiness out of your monthly budgeting by having a smaller amount coming out more frequently instead of a big amount one time a month. You can do an interest rate buy down. We're having some great success with this in the market right now, especially in the current interest rate environment. There's two types of buy downs in my experience. One is the long-term fixed rate buy down, where you pay a, some money, and instead of, let's say, a 7.5% interest rate, you get a 7% interest rate for 3 years. The other one is a short-term buy down, which will be a program like a 3-2-1 buy down that we're doing a lot on a project that we have right now that we're selling in Seattle, where your interest rate may be 7.5% fixed for 30 years, but you buy it down in this program. So your starting interest rate is 4.5%. Then it goes to 5.5. Then it goes to 6.5. And then finally it sets at 7.5. This can be a great program if you really think that interest rates are going to go down and you want to have a few years to be able to refinance into lower rates. Can also be a great program if you're anticipating your income going up a bunch. You know you've got raises coming, you know you've got some bonuses coming. You can use the 3-2-1 buy down to kind of step up into get more comfortable with higher payments. Can be a great option. And then another thing that's not often talked about, but is a brilliant strategy, I think I put the asterisk there because it's one of my favorites, is to do something called a house hack, and that can decrease your monthly outflow by bringing additional income into the property itself. You can use this strategy a bunch of different ways. You can do it on a SFR or single family residence or up to 2 to 4 units. One way that people house hack is like buy a duplex or add a additional rentable unit in the basement and then rent that out and use that income to offset their mortgage payment. Same with the duplex. You could buy a duplex for a similar price as your house and get the rental income and cut your mortgage significantly. This is a great strategy to consider, especially if you are a little more payment challenged, if you're a fixed income, things like that. It's going to be a great way to supplement and make things more affordable for you.